Corporate finance practice problem using Excel. Dividend projection for the corporation or company life cycle. Get ready. It's time to take our chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. Information on the left-hand side, we're going to populate that into the blue area on the right-hand side. We're considering the life cycle, projecting out the life cycles and the dividends that will be related to it. So we're going to have stages, and we're going to say the dividends during the development stage, no dividends, because we would assume during the development stage that any revenue that is generated will be going back into the company as they grow to help with the growth. And then during the growth stage, dividends as a percentage of income, meaning the net income for the company, we're assuming 15% will then be paid out. And in the expansion stage, the payout ratio will be, we're assuming, 32%. And then in the maturity stage, the payout ratio is going to be 51%. So we're projecting out the stages of the company. And you could think about, of course, the standard company. This would be a general kind of concept that we would consider with regards to what would happen with dividends. When growing, we would assume the money would be going back into the company in order to support the growth that would be needing, hopefully growing at an expanded rate. And then as we grow, we have the dividends then increasing. Then once we get to a more mature state in the company, you would think the growth would then level off. Hopefully the company then now be maintaining a nice steady flow going forward, but not having that rapid growth curve. And at that point, you would assume that the revenues that are generated don't need to be put back in the company due to the fact that you're not in that rapid growth phase, and therefore you can have those steady dividends that can be then paid out to the owners. So we're going to say that the earnings per share are going to be these items for the development, growth, expansion, and maturity stage. And then once we calculate the estimated dividends per share, we'll think about the investor shares, or one investor having 4,400 shares at the maturity stage, and think about what the investor after-tax income would be. So let's go back up top and just think about the dividend kind of strategy or policy for these stages. So we'll start off with the development stage, and we're going to take the earnings per share, which is going to be the 0.25 as what we estimated. Now I'm going to select these. Well, let's select this first cell. I'm going to go to the number group, add some decimals. Let's add the 4 stages here, which is going to be the growth stage, the expansion stage, and the maturity stage, looking like that. And then I'll just simply copy down this formula, which should pick up the relative references on the left-hand side. So I'm going to put my cursor on it, autofill handle, grab that autofill handle and drag it down, picking up then the relative references on the left-hand side. Closing that up, then we have the ratios that we need to pick up. That's going to be these items. So we'll pick up the percent ratio for the development stage, which of course is 0. Then we'll take a look at the growth stage, 15%. I'm going to make all 4 of these a percent type of cell, selecting the cells, number group, percentifying it. Then we will pick up then the next stage, which is the expansion stage, the 32%, and finally maturity stage at the 51%. Multiplying this out, then we're going to take our earnings per share and then multiply it times our payout ratios. So we're going to take the earnings per share times the 0%. I'm going to copy that down. It should then multiply these across. Going to copy that down using the good old autofill. And then we're going to add some decimals, saying the number group and adding a couple decimals here. So this is going to be the payout that we're estimating on a per dividend basis here. So that's what we have for our 4 stages. So given that, we can think about the investor dividend income. So let's go to our scenario down here where we have our investor, which we are imagining is in the maturity stage down here. The dividends then were estimated to be, as we calculated up top, at the 2.3 per share. So if we had an investor at that stage, we're going to say, all right, well, the shares then are going to be, we said, are equal to, if they had 400 shares, an individual investor, and the dividends per share, are going to be equal to, at this point, we calculated the dividends to be the 2.3. Let's go ahead and add some decimal number group, couple decimals. We're going to go to the font group and underline. That's going to give us our total. I'm just going to call it total. And this is going to be the 400 shares times the 2.3 per share. That's going to give us the 918 on the dividends. 918 on the dividends. Let's calculate the after-tax income then. After-tax income, if we had the dividend income, which we calculated up top, dividend income. So if we're the investor now, we got to pay taxes on that, most likely. So it's going to be, we're going to have a subcategory, which I'm going to call 1 minus the tax rate and colon. So I'm going to say 1 minus the tax rate, which we're going to assume here at the 15%. Tax rates, of course, can change, but the concept will remain much the same. Remember that dividends sometimes can be taxed at preferential rates, different rates than ordinary income possibly. So you got to take a look at whatever the tax code is at any given time. Font group and then underline, and that's going to give us our total, which we said was the 1 minus the tax rate. And putting that on the outside, let's pull that to the outside. This is going to be 1 minus the 15%, making that a percent, number group percentifying it. That's going to give us the 85%. So in other words, government takes 15%. How much do we get to keep then? We get to keep 85% of the income. How much income did we get? Dividend income, 918. Let's do some indenting down here. I'm going to select these 3 items, go to the alignment and indent. Select this item, alignment and indent again, and we'll call this then the investor after-tax income, which is going to be equal to the 918 times the 85%. We're at the 780. Let's add a couple decimals, number group, because we got 30 cents here. And then we'll underline right here, fonts group and underline. So the general idea here is if you're projecting out or just thinking out about dividends in general, either from the standpoint of making the dividends from the corporate standpoint or investing in a company, you would typically think of a cycle that would be similar to this, meaning in the growth stage, we would try to be putting all our money back into the company in order to pay for the expansion, because we have a rapid expansion we're hopefully happening at that point. That's going to be in the development stage. And then in the growth stage, we would expect some more dividends possibly as we start to mature as a company, investors wanting to see possibly some returns then. And then same with the expansion stage. And then at that maturity stage, that's when you're thinking about the companies that are going to be basically not having that steep growth line, but hopefully the steady growth line at that point in time, not taking the money so much, needing it to reinvest, but using that steady growth then to pay out the dividends to the common stockholders. Now, you also might think of, well, when might other types of activities happen within the cycle of the company, like stock splits or dividend splits and things like that. And you would expect that to happen somewhere in here in the growth stage and the expansion stage generally as things go on, and once the maturity stage is hit, possibly having some more stability, which is something that kind of you would expect of the maturity company. Many people that are investing at that point in time looking for consistency, stability, common, a set amount of dividends and activity at that point in time. People up in this stage, the company might be making obviously some changes and adjustments as they go, which could include readjustments for things like stock dividends and stock splits.